Right now, inside a restricted analysis folder shared between 3 sovereign debt units and 2 monetary policy departments, there sits a document with a working title that sounds harmless enough: Fiscal Optics and Balance Sheet Reality: Measurement Gaps in Growth Accounting. The first page opens with a line that does not sound harmless at all. When headline gross domestic product expands while the underlying system slides toward technical insolvency, the question is not whether collapse will occur, but who will be holding the instruments when recognition arrives. Below that line, there is a table. On the left column, official growth figures for a major developed economy over the past 15 years. On the right column, total system debt as a percentage of that same economy. The left side shows steady positive numbers. The right side shows a curve that crosses 300% and keeps climbing. At the bottom of the page, one sentence in small print: markets price the left column. Bankruptcy tribunals will reference the right. This analysis was not produced by an opposition think tank or a fringe commentator. It was assembled by career economists inside institutions that do not benefit from panic and do not publish unless the data has been checked multiple times. The document does not name the country directly, but the parameters are clear enough for anyone with access to sovereign debt databases. The economy in question still appears on every list of safe jurisdictions. Its bonds are still rated investment grade by major agencies. Its currency is still used for reserve holdings by central banks in other regions. And yet, according to the internal math in this folder, the system crossed the threshold of technical insolvency somewhere between 2018 and 2021. The trigger was not a single crisis. It was the compound effect of decades during which every apparent recovery was built on an expanding base of obligations that could not, under any realistic scenario, be honored in full. The discovery of this pattern did not come from a whistleblower or a sudden leak. It came from a routine task: reconciling published fiscal data with unpublished central bank balance sheet expansions and unfunded liabilities in pension and social security systems. One analyst noticed that the standard models used to assess debt sustainability were producing results that made no sense. According to those models, the country should have faced a funding crisis years ago. Yields should have spiked. Currency should have weakened. Instead, growth continued. Markets remained calm. The analyst ran the numbers again, this time adding in off-balance sheet obligations and the present value of entitlement promises. The new total was not twice the size of the economy. It was not 250%. It was over 300% and rising every quarter. When that figure was cross-referenced with tax revenue projections and realistic growth assumptions, the conclusion was unavoidable. Under normal conditions, this system would be insolvent. It was surviving only because the conditions were not normal. The first institution to notice was a credit analysis unit inside a European bank. They were modeling exposure to sovereign debt and ran a stress test that assumed a return to historical interest rate averages. The model broke. Debt service costs exceeded total tax revenue within 3 years of normalization. They assumed the model had an error. It did not. They shared the results quietly with counterparts in 2 other institutions. Those teams ran their own versions. Same outcome. By late 2022, at least 6 independent units had reached similar conclusions, but none of them published. The reason was straightforward. calling a major economy insolvent when markets are still pricing it as safe creates reputation risk and legal exposure. So the findings stayed internal. They circulated as restricted memos. They were discussed in closed sessions, and they were logged in documents like the one sitting in that folder today. To understand why this matters, it helps to go back to how sovereign debt sustainability is supposed to work. A government borrows to fund operations, infrastructure, or emergencies. It issues bonds. Investors buy those bonds based on an assessment of the government's ability to repay. That assessment rests on a few key variables: the size of the economy, the growth rate, the tax base, and the interest rate on the debt. If the economy grows faster than the debt, the burden shrinks over time in relative terms. If the interest rate stays below the growth rate, the government can keep rolling over obligations without a crisis. This is the baseline logic. It is taught in every economics program. It underpins sovereign credit ratings. It is the foundation of the entire government bond market. NG. The control system is supposed to function like this. The finance ministry projects revenues and spending. The legislature approves a budget. Independent statistical agencies track the actual results. If deficits grow too large, credit rating agencies downgrade the debt. Yields rise. The government faces pressure to cut spending or raise taxes. This feedback loop imposes discipline. It prevents a government from borrowing indefinitely. For most countries, this system works. If they try to run sustained deficits above a certain threshold, the market punishes them. Yields spike. Refinancing becomes expensive. The government is forced to adjust. The mechanism is not perfect, but it is functional. It has stopped many states from sliding into uncontrolled debt spirals. But this logic depends on one critical assumption: that the market has accurate information and prices risk accordingly. And that assumption, according to the restricted document, no longer holds for certain large economies. The reason is a combination of central bank intervention, reserve currency status, and regulatory frameworks that treat sovereign debt as risk-free regardless of the actual numbers. When a central bank can buy unlimited quantities of government bonds, the normal price signal disappears. When pension funds and banks are required by law to hold government debt and can count it as zero risk for capital purposes, demand becomes structural rather than economic. When the currency is held globally as a reserve, foreign central banks absorb issuance not because they expect full repayment, but because they need the liquidity for trade. In this environment, the usual feedback loop is broken. The government can run deficits far beyond what would be sustainable for a normal borrower, and the market does not react. Growth can be reported as positive even when the denominator is being artificially inflated by monetary expansion. The system looks healthy on the surface. Underneath, the numbers tell a different story. The anomalies began to surface in stages, and they did not arrive as dramatic revelations. They emerged as small inconsistencies that, when aggregated, formed a picture that contradicted the official narrative. The first anomaly was straightforward. The reported gross domestic product figures included components that were not tied to real economic output. In several quarters between 2015 and 2023, a measurable portion of growth came from increased government spending, financed entirely by central bank bond purchases. This spending was counted as economic activity. It appeared in the GDP calculation. but it was not funded by taxes or private sector investment. It was funded by newly created money that expanded the central bank's balance sheet. The second anomaly involved the treatment of debt in official statistics. Most analyses focused on gross government debt as a percentage of GDP. That figure, for the country in question, hovered near 120%. But this number excluded several categories of obligations. It did not include the unfunded liabilities of state pension systems. It did not include Social Security commitments. It did not include guarantees extended to financial institutions or state-owned enterprises. When independent researchers added those items, using actuarial present value calculations, the total system debt climbed past 300% of GDP. Some estimates put it higher, and yet, in official discourse, the 120% figure was the one cited. The larger number existed in technical papers and actuarial reports, but it was not part of the public conversation. The third anomaly appeared in interest rate behavior. According to standard debt sustainability models, when a country's debt crosses certain thresholds relative to the size of its economy, yields on government bonds should rise. Investors demand higher returns to compensate for increased risk. For decades, this relationship held. But beginning in 2009 and accelerating after 2020, it stopped working. Debt levels climbed, deficits widened, and yet yields on long-term government bonds stayed low, and in some periods turned negative in real terms. The explanation offered by officials was that markets had confidence in the country's long-term growth prospects. The explanation offered in the restricted analysis was different. Yields stayed low because the central bank was the largest buyer. When the central bank commits to purchasing unlimited quantities of government debt, the market price is no longer set by private investors assessing risk. It is set by policy. The fourth anomaly involved the structure of the economy itself. Official growth numbers showed expansion. But when broken down by sector, the picture changed. Manufacturing output as a share of GDP had been declining for 2 decades. Productivity growth, the key driver of long-term prosperity, had slowed to near zero in several advanced economies. What was growing instead was the financial sector, real estate valuation, and government consumption. In other words, the economy was not producing more goods or services per capita. It was inflating asset prices and counting government spending as output. This created the appearance of growth without the substance. Wages stagnated, household debt rose, the middle class contracted. But the headline number kept moving up. The fifth anomaly was demographic. The country in question, like many advanced economies, was aging rapidly. The ratio of working-age citizens to retirees was falling. This meant that the tax base was shrinking relative to the population that depended on government transfers. Pension systems designed decades earlier assumed a different demographic structure. They assumed more workers per retiree. They assumed steady wage growth. They assumed investment returns that no longer existed in a zero interest rate environment. When actuaries recalculated the liabilities under realistic assumptions, the gap between assets and obligations widened into the trillions. And yet political leaders continued to promise benefits at levels that could not be funded. The fiscal implications of aging were well understood inside ministries of finance. They were not, however, reflected in public debt figures or in market pricing. The sixth anomaly concerned the role of the central bank. In the decades before 2008, central banks operated with a clear mandate: control inflation, maintain currency stability, and act as lender of last resort in financial crises. After 2008, that role expanded. Central banks began purchasing government bonds in massive quantities, not as a temporary measure, but as a permanent feature of policy. They began setting interest rates not based on inflation targets alone, but based on the need to keep government debt service costs manageable. In effect, monetary policy became subordinate to fiscal policy. The central bank was no longer independent. It was the funding mechanism for a government that could not finance itself through normal channels. This shift was never formally announced. It happened through a series of emergency measures that became permanent, and it meant that the traditional checks on government borrowing had been removed. The seventh anomaly appeared in the banking system. Under international regulatory standards, government bonds issued by developed economies were treated as zero-risk assets. Banks could hold unlimited quantities without setting aside capital. This created artificial demand. It also created systemic fragility. If those bonds ever lost value, or if a government ever restructured its debt, the banking system would face immediate losses. The regulatory framework assumed that such an event was impossible. The internal analysis suggested that it was not only possible, but increasingly probable. And when analysts modeled what would happen if yields rose by just 2 percentage points, the results were severe. Banks would face capital shortfalls. Pension funds would see their asset bases erode. Insurance companies would struggle to meet obligations. The entire financial system was built on the assumption that government debt was safe. If that assumption broke, the system broke with it. Two broad hypotheses emerged from this analysis. The first was the accident hypothesis. Under this interpretation, no single actor intended to create an insolvent system. It happened through a series of individually rational decisions. Politicians responded to voter demands for services without raising taxes. Central banks responded to financial crises with aggressive intervention. Regulators designed rules that assumed government bonds were safe because they always had been. Pension funds made return assumptions that seemed reasonable at the time. Each decision taken in isolation made sense. But when compounded over decades, they produced a system that could not be sustained. In this view, the current situation is a policy error, not a conspiracy. The solution would involve painful adjustments, spending cuts, tax increases, debt restructuring, but it would be manageable if addressed soon. The second hypothesis was more uncomfortable. It suggested that key decision makers understood the trajectory and chose not to stop it. In this interpretation, the system was being deliberately extended because certain groups benefited from the transition. By keeping asset prices inflated through monetary expansion, wealth holders avoided losses. By maintaining low interest rates, governments avoided immediate fiscal crises. By treating unsustainable debt as normal, elites had time to shift their own wealth into harder assets: land, commodities, foreign holdings. When the system eventually reset, the losses would fall on those who held nominal claims: pension recipients, bondholders, savers. The real assets would have already changed hands. Under this hypothesis, the extend and pretend strategy was not an error. It was a wealth transfer mechanism disguised as economic policy. Distinguishing between these two hypotheses required evidence that was not yet public. It required access to internal communications between Treasury officials and central bankers. It required asset allocation data for political elites and senior financial executives over the past 15 years. It required an understanding of whether large institutional investors had quietly reduced exposure to certain sovereign debt markets while publicly maintaining confidence. Some of this evidence existed in confidential files. Some of it might surface through leaks or investigations. But at present, the question remained open. What was not open was the arithmetic. Regardless of intent, the numbers did not balance. The system was running on the assumption that growth would return, that interest rates would stay low, that demographics would stabilize, and that markets would continue to absorb debt. If any of those assumptions failed, the entire structure would face a reckoning. Global institutions were watching. The International Monetary Fund published periodic reports on fiscal sustainability. The language was cautious, but the warnings were clear. Advanced economies needed to reduce deficits. Debt trajectories were unsustainable. Fiscal space was narrowing. The Bank for International Settlements issued similar assessments. Credit rating agencies maintained high ratings, but added footnotes about long-term risks. None of these institutions used the word insolvency. None of them predicted a specific crisis date. But the pattern of their statements, when read over time, showed increasing concern. The baseline assumption in most official forecasts was that governments would eventually implement reforms. The assumption in the internal documents was different. Reforms were politically impossible until a crisis forced them. Markets, for now, remained stable. Yields on government bonds were low. Equity markets reached record highs. Real estate prices continued to climb. To most observers, this looked like health. To the analysts who wrote the restricted document, it looked like the calm before repricing. The analogy they used internally was this. Imagine a bond trading at par that carries an obligation the issuer cannot meet. As long as no one questions the obligation, the bond trades normally. But the moment doubt enters the market, the price adjusts instantly. There is no gradual decline, there is a jump. And once that jump occurs, confidence does not return easily. The fear among the restricted analysis community was not that the system would fail slowly. It was that it would fail all at once. When some external shock or internal revelation forced markets to reprice sovereign risk across multiple economies simultaneously. The final section of the document did not offer predictions. It offered a framework. If the current system is primarily a technical error, then the correction will be painful but survivable. Governments will restructure obligations. Central banks will allow some defaults. Taxes will rise. Benefits will be cut. Growth will slow. But institutions will adapt, and a new equilibrium will emerge. If, however, the current system reflects a deliberate strategy to extend the cycle and transfer losses, then the question is not whether there will be a reset, but who will be left holding the devalued claims when that reset occurs. And the final question, left for the reader of that document, is simple and unresolved. When you look at an economy where gross domestic product grows while total system debt exceeds 300% of that same product, and where every pillar of sustainability rests on assumptions that have not held for 15 years, do you see a system adapting to challenges, or a system that has already passed the point of no return and is simply waiting for recognition to catch up with reality?